This is Financial Accounting, and I am Dr. Baldwin. In Chapter 3, we'll look at the timing of reports and the need to adjust the accounts. Adjusting entries are necessary because not all transactions begin and end in one accounting period. For example, a customer may purchase inventory at the end of December and not pay for it until January of the following year. Adjusting accounts is important for recognizing revenues and expenses in the proper period. Toward the end of the chapter and in the second lecture, we will review the preparation of our basic financial statements. The most common accounting period is 1 month. Companies also prepare quarterly reports and semi-annual reports. At the end of each year, most companies prepare an annual report of operations and financial position. When we divide business activities into arbitrary fixed points of time, it's often necessary to have special accounting for transactions that cross from one time period into the next. Most of our time will be spent looking at the special adjusting process for some of these transactions. The accrual basis of accounting dictates that revenues be recognized when earned and expenses be recognized when incurred. You've heard me use these terms before. The accrual basis of accounting is considered to be in compliance with generally accepted accounting principles, or GAAP. The cash basis of accounting dictates that revenues be recognized when the cash is actually received and that expenses are recorded when the cash is paid. The cash basis is not considered to be in compliance with GAAP. While you may be on the cash basis for your personal transactions, like many of us are, almost all companies follow the accrual basis of accounting because that is what is required by GAAP. We believe the cash basis waits too long to recognize revenue and expenses and therefore misstates income. So let's look at some transactions and see what I'm talking about here. In our first transaction on December 1, 2011, Fast Forward paid $2,400 cash for a 24-month business insurance policy. So they've paid in cash for something that's going to cover 2 years, 24 months, that's 2 years. On the cash basis, the entire $2,400 would be recognized as an expense in 2011, even though the policy provides protection for 2011, 2012, and 2013. Remember, they're buying it on December 1 of 1 year. That means it's going to cover that month, the 12 months of the following year, and 11 months in 2013. Let's look at how this type of transaction is handled on an accrual basis accounting system. On the accrual basis, we record $100 of insurance expense in the month of December 2011, $100 for each month in 2012, and $100 for the months January through November in 2013. We are matching the expense with the periods that are benefited by the insurance coverage. This is a better cost matching of revenues and expenses. We want to match our expenses to the revenues that they were incurred to produce. So why did we incur this expense over this period? So that we could generate revenues over that period. So we want to recognize the expense spread over that period. Here is the framework for adjusting the books of a company. There are 2 broad categories of adjustments. The first is when we pay or receive cash before the expense or revenue is recognized. This category includes prepaid or deferred expenses, including depreciation, and unearned or deferred revenues. You can use either one of those terms, unearned or deferred. The second major category, that's the green box on the right, is when cash is paid or received after the expense or revenue is recognized. These are some very common adjustments. The category includes accrued expenses and accrued revenues. So we've got deferred expenses and deferred revenues, and we've got accrued expenses and accrued revenues. In the example earlier that dealt with the insurance premium being paid ahead of time, we demonstrated how a prepaid expense would properly be accounted for. This is summarized in the slide above, where we increase or debit an expense account and reduce or credit an asset account. Now let's look at an example of the supplies adjustment. In our second transaction, Scott Company spent $15,500 on office supplies during 2011. That's a lot of money. When the supplies were purchased, an entry was made to debit or increase the asset account supplies, and the cash account was decreased. On December 31, 2011, the balance in the supplies account was $15,500. On that date, we conducted an inventory of the office supplies on hand and determined that we still had $2,655 in supplies. That means we've used up the other supplies. So we've done an inventory to see what we have left, and that will tell us how much we have used up. So let's make the adjusting entry required on December 31, 2011 to get the balance in the supplies account stated properly. Debit or increase supplies expense by $12,845. That's the amount of the supplies used. And credit or reduce the asset account supplies expense by the same amount. If we had supplies available of $15,500 and only had $2,655 on hand at the end of the year, we must have used $12,845 worth of supplies during 2011. So we can post the adjusting entry that you see here. We have debited supplies expense, credited supplies, and you can see that reflected in our T accounts. Now, let's look at a new type of adjusting entry. Plant assets, with the exception of land, are depreciated over their useful lives. Depreciation is the process of allocating the cost of a plant asset over its useful life in a systematic and rational manner. At this point in the accounting process, we want to introduce you to a depreciation method known as straight-line depreciation. Straight-line depreciation is the most popular method used by companies. It's also the easiest. They determine the amount of annual depreciation by taking the cost of plant assets, subtracting the estimated salvage value, in other words, what they think that asset is going to be worth when it's used up, and dividing that amount by the useful life of the asset. The salvage value is the amount we expect to receive for the asset when we dispose of it at the end of its useful life. We're subtracting that out because obviously that's going to be left. In a later chapter, we will discuss other acceptable methods of depreciation. For now, let's look at the adjusting entry to record depreciation expense. On January 1, 2011, Barton purchased equipment for $62,000 cash. The equipment has an estimated useful life of 5 years and an estimated salvage value of $2,000. How do we determine the annual depreciation expense? We do that by taking the cost of $62,000, subtracting out the estimated salvage value, and dividing it by the 5-year useful life. That means we're going to depreciate $12,000 each year. Now let's record the adjusting journal entry for that. On December 31, 2011, we will debit or increase depreciation expense for $12,000 and credit a new account called Accumulated Depreciation Equipment. This is a totally new kind of account. This account reduces the related asset account. It's called Accumulated Depreciation. We usually write it as Accumulated Depreciation and then a hyphen and then whatever kind of equipment or asset that we're depreciating. In this case, it's equipment. Accumulated depreciation is a contra asset account. A contra account means that the amount in the account reduces the related asset account. So accumulated depreciation reduces the asset known as equipment. Because this is a new type of account, let's look at the treatment of the contra and related asset account. We have posted the adjusting entry to record depreciation expense. We have also shown you the balance in the equipment account. The depreciation expense account will appear on our income statement for the year ended December 31, 2011. The accumulated depreciation balance will be used to reduce the carrying value of the equipment account on the balance sheet. It's going to look something like this. The contra account, accumulated depreciation, is shown as a reduction, so you can see the parentheses for subtracting or decrease, a reduction in the cost of the asset equipment. So the asset is shown net of the accumulated depreciation. It's shown with that number subtracted out. That's its net value, its net amount, or its book value. There's a term you're going to hear a lot of, book value, or $50,000. Because the contra account appears on the balance sheet, it will not be closed at the end of the period. So when we start talking about closing entries in the next lecture, you'll remember, hey, I'm not a closing accumulated depreciation because it shows up on the balance sheet. It'll be carried forward to next year and used to accumulate the depreciation related to the equipment next year and the following year and so on. Now let's move on to the second category of adjusting entries, deferred revenues. When accounting for deferred revenues, we're faced with a transaction where cash is received in advance of providing the product or service. So someone's paying us in advance. In other words, we've got the cash, but we haven't done anything to earn it yet. In our example, we will examine accounting for the sale of season tickets to a university's home basketball games. When dealing with adjustments for deferred revenues, we always debit or reduce a liability account because we've delivered the service or the goods, and credit or increase a revenue account. So let's see what this example looks like. On October 1, 2011, Ox University sold 1,000 season tickets to its 20 home basketball games for $100 each. On the date of sale, the university made a debit or increase to the cash account and a credit or increase to a liability account called unearned revenue. It could have been called unearned basketball revenue even. We know the use of the word revenue can be a little confusing here, but we're putting the word unearned in front of it. That's a key word. The university's done nothing to earn the revenue from the sale of the tickets. So what have they done? They have credited an account, a liability account, called unearned revenue. Yes, it has the word revenue in it, but if it has unearned in front of the word revenue, you know it's a liability. It's not revenue yet. It's not revenue until we've earned it. So this is what happened at the time we sold the tickets, before the basketball games happened. Now let's look at the adjusting entry the university will make at the end of the year, the end of the accounting period. As of December 31, 2011, the university had played 10 home games and compiled a record of 2 wins and 8 losses. That doesn't sound too good. Let's make the adjusting entry. The adjusting entry is to debit or decrease the liability account called unearned revenue. So we've earned a big portion of this revenue, and we're going to show that coming out of the unearned revenue account, which is a liability account, and putting it into the revenue account. We're taking it out of an unearned revenue, which is really a liability account, and we're putting it into a real revenue account. The basketball revenue account now has a credit balance of $50,000. The revenue account will appear on the income statement and be closed at the end of the accounting period. The liability account, unearned revenue, will appear on the balance sheet at the end of the year. Wow. That's a weirdo thing. That unearned word is very important. It's the key word there. If it says unearned in front of the revenue, you know it's not a real revenue, it's a liability. You haven't earned the revenue yet. But once you've earned it, whenever you're at the end of an accounting period, you've got to adjust for what you've already earned, and that's what we've done here. Now, let's change the subject and look at adjustments for accrued expenses. Remember, there are 4 types of adjustments, and this is the third one. An accrued expense is defined as a cost incurred in the current period that is both unpaid and unrecorded. When you use your credit card, often you don't record the transaction until you pay your monthly invoice, even though you've already incurred the cost. For all accrued expense adjusting entries, we debit or increase an expense account because we're recognizing that expense. And we credit or increase a liability account because we're recognizing, hey, we're going to have to pay this at some time in the next period. Let's look at a specific example of this. Barton Inc. pays its employees every Friday. The current year end, December 31, 2011, falls on a Thursday. As of December 31, 2011, the employees have earned salaries of $47,250 that will not be paid until the following Friday, January 1. So, for the end of the year, what are we going to do? We have to think about the dates. They've worked through 12/31, right? They haven't been paid since sometime in the past. In this case, it was 12/25. But the next pay date is sometime in the future. But they've already earned this pay. We owe it to them, even though we're not going to pay it to them until the next period. So we need to record an adjusting entry on December 31, 2011 to recognize the salaries earned by the employees but not yet paid. Here's the adjusting entry. In our adjusting entry, we debit or increase salaries expense and credit or increase salaries payable. We're accruing 4 days worth of salaries here. After the adjustment, salaries expense is stated properly. In other words, we know how much we incurred for the year. Even though we haven't paid them yet, we still have the liability. We still owe them, and we're recognizing the expense in the appropriate period. If we didn't make this kind of adjusting journal entry, we would not be recognizing this salaries expense until we actually paid them. That would take 4 days worth of salaries and stick them in the wrong year from an accounting perspective. Salaries expense recorded during the year amounted to $657,500. You can see that in the T account. All right, that's what we had so far. After posting our adjusting entry, the new balance is $704,750. The salaries payable account will be eliminated. So we've created this liability here when we actually pay the employees on January 1, 2012. Now, let's move on and look at our fourth kind of adjusting entry, accrued revenue. The term accrued revenues refers to revenues that have been earned in a period that have not been recorded and the money hasn't yet been received. So we haven't been paid and we've already done the work. So we've got to record that we've earned it and record that someone owes us for it. This adjusting entry is needed because many firms deliver a product or provide a service before they're going to get paid. They haven't recorded it yet in the current period. The process hasn't gotten far enough. You can see our example of an accountant who prepared a tax return for a client but has yet to bill the client. The accountant has earned the revenue but hasn't recorded it at year end. In adjusting entries to record accrued revenue, we will always debit or increase an asset account. Usually it's some kind of receivable, in this case it's account receivable, and credit or increase a revenue account. In this case it's service revenue. Look at our example. Smith & Jones CPAs have completed work amounting to $31,200 at the end of the year. But they haven't yet billed this amount to those specific clients. Let's look at the necessary adjusting entry. What are we going to do? We're going to do exactly what I just mentioned. The company is going to debit or increase the asset, accounts receivable. So here's our debit, accounts receivable. And it's going to credit or increase the revenue account. We'll call it service revenue for the $31,200. You see our journal entries in balance. You can see, hey, we can post it. Could talk you through that. We can post it to the T accounts, and you can see that our accounts receivable will now reflect the fact that we're owed this money, and our revenues will now reflect the fact that we have earned this money and presumably will be paid at some point. So we've updated those accounts to include the earned but unbilled amount of the services provided. This slide provides a summary of the adjustment process. This summary will probably prove pretty useful when completing your homework or studying for the next exam. So in your notes, put a big star next to this one over, I've given you plenty of room to write notes on the PDFs. Put a big star next to this one because you're going to want to come back to it. Here's how you read the table. Before we record a prepaid expense, the assets of the company are overstated and equity, or expenses in this case, are understated in the current period. If the expenses are understated, what's happening? Equity is overstated. So expenses understated, that affects the income statement account. So this is what's wrong. These things are not where they ought to be. So we make the adjusting journal entry. We debit an expense to recognize the expense, so we're no longer understating expenses and overstating equity. And we credit the asset so that the asset is no longer overstated. Now, you can read through the rest of them on your own. That just gives you an idea. Now, let's look at the next slide where we're going to talk about the adjusting entries and the financial statements. This kind of worksheet can be prepared by hand or can be prepared using Excel or any kind of tool like that. We're going to begin with the unadjusted trial balance. That's sort of where we ended the previous chapter. We called it the trial balance, but it was really the unadjusted trial balance. You just didn't know it needed to be adjusted yet when we were in the previous chapter. So we're going to start with that unadjusted trial balance. That's the trial balance before we make our adjusting entries. Now we're going to post our adjusting entries. So you can see those in the center here, the green sort of columns. Look at adjusting journal entry C. This is the entry to record depreciation expense. You can find the expenses debited here, and you can find up here accumulated depreciation for equipment is credited. Do you recall this type of adjusting entry from our previous discussion? I hope so. Notice that the total of the debits and the credits are equal in the unadjusted trial balance and in the adjustments column. Everything has to stay in balance. Now we can take these balances in the unadjusted trial balance, adjust them by the adjustments, and then we will have the adjusted trial balance. So let's add the adjustments, and that gives us the adjusted trial balance. That's what you see in the final two columns here. The adjusted trial balance combines the unadjusted trial balance account balances with the adjustments that we've made. Be careful when doing the arithmetic. For example, look at entry B. Entry B, we have a debit to supplies expense and a credit to supplies. It's the entry that adjusted the supplies account for the physical inventory taking at year end. The supplies account on the unadjusted trial balance is $9,720. Our adjustment reduced the supplies on hand, so the adjusted trial balance account is $8,670. You have to be very careful as you're doing the math. Once we've completed the worksheet, we can move on to the preparation of the company's financial statements, but we'll save that for the next lecture. First, let's talk just a little bit about financial statement analysis as presented in this chapter. This chapter includes two common ratios in the financial statement analysis section at the very end, the profit margin and the current ratio. The profit margin is very simple, but it's an important measure in business. It tells us about the relationship between sales and profits or net income. We calculate the ratio by dividing net income, that's the very bottom of our income statement, by the sales revenue for the same period. Sales revenue is usually one of the very top things on the income statement. A high profit margin is an indicator of future growth. So this is going to come out as a percentage, and you're going to say, oh wow, 75%, that's really high, or oh wow, 10%, that's really low. The current ratio of a company gives us a good indication of the company's ability to pay its debts when they fall due. The current ratio is calculated by dividing current assets by current liabilities. Current means short term. Short-term assets, very liquid. Current liabilities, short-term, have to be paid in a year or less. Let's look at a quick example. Suppose we have a company that has $200,000 in current assets and $100,000 in current liabilities. The current ratio is 2 to 1. That is 200,000 divided by 100,000. A 2 to 1 current ratio means that for each dollar of current liabilities falling due in the next year, we expect to have $2 of current assets to pay the liabilities. So we can meet our short-term obligations. That concludes this lecture. Now move on to your homework assignment. This chapter's homework is quite lengthy and time-consuming, so you're going to want to spread the assignments over 2 or 3 days to lighten the load. If you try to do it all in one sitting, you're going to be sitting for a very long time. Spread it out over 2 or 3 days, and if possible, over those days, spread it out into more than one effort. Don't just sit down for hours at the time. That'll just frustrate you, and also your brain can only handle so much, so try to spread it out. Good luck.